The
you.
question is how long those high oil prices can last for. Please, just if you wouldn't mind, just repeating your sentiment for our viewers.
Yeah, for me, I'm still constructive on the oil price. I do know that supplies in the U.S. are very high. I know that, the draws have been fairly decent the last 2 weeks from the inventory reports, but we're still 2.5% away from the all-time high in inventory that we saw last March. But that said, I still think with the geopolitical situation, with the agreement in OPEC, and also the balanced markets elsewhere, or the markets going towards balancing, I do think we're going to start seeing a draw. Not anytime soon. I used to think it was going to start happening now. I don't think we'll see it till the third or fourth quarter of this year, but I do think prices will continue to rally. It's going to be tough, but they will.
In the meantime, then, we're sub 10 days out from this OPEC meeting in Vienna. I mean, how do investors look to trade oil in the meantime?
Well, I think what you need to do if you're going to be trading the futures, I think, I would look at Brent before I look at WTI and look for any kind of washout to buy. I mean, the risk reward on oil right now is enormous. Maybe not so much in the futures market, but definitely in the equity market that's related to energy. But all that to say is that when you see any kind of washed out market in Brent, it would be an opportunity for me to buy, thinking that the risk reward is there right now.
So with that in mind, when it gets to that Vienna meeting, you foresee OPEC rolling over these cuts for a further 6 months?
Yeah, I mean, I'm thinking that they will. I think there's going to be, addendums to it, but I do think they will roll them over. But I'm basing my whole thesis on that, and that's why I think the risk reward is so high, because if it doesn't go through, then it's going to be disastrous near term for the market.
The question I would ask here, Larry, is will 6 months be enough, though, to rebalance the market?
Yeah, no, it definitely is enough to rebalance the market, in my view. I wouldn't have said that 3 or 4 months ago, but I see how much supply is coming on board. Yeah, I do. But I do think that, the draw in the market isn't not going to occur until probably late third quarter, early fourth quarter.
I wanted to just move away from OPEC for a moment, because we do have sort of the other side of this equation, which is U.S. crude production. And we, in fact, saw a pullback for the first time in 13 weeks. Alaskan output declined by 21,000 barrels a day. However, Larry, production continued to increase in the lower 48 states. Just give me your take in terms of what we are seeing on that U.S. side of the equation, of this story.
Yeah, well, I think the last two inventory reports have been really surprising. The draws have been a little bit more bullish for oil than most people have expected, but I'm very concerned that we're only 3 months away, or 2.5% away from an all-time inventory high. So it seems to be a big surprise how, in other words, you just can't discount shale in the lower 48 states. And that's why I'm moving more towards looking at Brent as opposed to WTI, because I think it's a big wild card.
How is the commodity space then? How does this fit into your overall portfolio weighting?
Yeah, I look from a top-down approach, and I think when I look at the commodity market as a whole, let's face it, it's derated by 10%, sometimes even more than that, as people that are trading iron ore well know. And I think the risk-reward to that is that I think, we're seeing global momentum, perhaps late stage here in the U.S., but the globe is growing. Inflation, that could be a wild card for pricing going forward. However, I do think because there's been such a derating in the price since the beginning of the year, it's a good time to get in.
Just on that note also, Larry, I wanted to get your take in terms of, it has actually been quite a quiet week news flow-wise over the last fortnight, but obviously many of the developments going on in Washington, D.C. at the moment, they've really turned that on its head. We're seeing the volatility index closing at its highest level since mid-April. How is all of this feeding into your approach also?
Yes. Yeah, well, I didn't take Washington, D.C. too seriously as the market rallied, and I'm definitely not going to take it too seriously with the market going down today, even though it's a big down move, because I really do think that its nominal growth is slowing. It's plateauing at a reasonably high level, and the market just can't sustain. We've had benign volatility for a very long time. Trading is very crowded. That's why we saw bank stocks down 4% today, semiconductors down 4%, even small cap Russell down 2.5%. It's nominal growth, but it's also Treasury yields. I mean, we have the 10-year yield here at 2.21. I mean, a week ago it was almost 2.40, and you have the 2.10 spread down 5 basis points today to below 100. That's before the election. So really have to watch the yield markets, and that's what's going to dictate how the stock market reacts.
Larry Shover, we'll leave it there. Thank you so much.